On the top three things this morning in my notebook, number one, we're going to go with sentiment in the U.S. equity market. Number two, all of Europe. And then number three, the 10-year bond yield itself. First, on sentiment, what I like to look at, if only because it backtests properly, is this thing called the II Bullish to Bearish Survey. Now, what I like to look at is the spread between bulls and bears. Now, this morning, that spread is over 4,000 basis points wide. That's the highest it's been almost for the entire year to date. It's up 99% versus where we were when people were in the fetal position on October the 13th. And again, the key takeaway of the bulls minus the bears is that there are no bears. So again, 14.8% respond that they are bearish, right around the all-time low. So again, people might say they're bearish, but they're definitely not position bearish, or at least saying in the survey that they're bearish. So that is a very bearish thing. Now, point number two is all of Europe. I had people, I love my Contra stream on Twitter. For those of you who watch it, again, I have a secretly organized list of people who say the kind of similar things at the same time, which you want to say is a contrarian indicator. And one of those indicators yesterday was that Europe trades great. Look at the charts. Again, analyzing Europe isn't about a chart. So get rid of the moving monkey and look at what's going on in Europe from an economic perspective, from a coordinated risk perspective, from a policy response perspective, and then look at the chart. Well, the chart doesn't look as good as it did yesterday. So if you look at the Italian MIB index down over 1.5% this morning, the DAX failed at what we call intermediate term trend resistance, and all of Europe really remains bearish trend. So again, European economic data continues to slow, and we reiterate the Europe slowing macro theme here at Hedgeye. Now finally, on the 10-year bond yield, the 10-year bond yield doesn't like a couple big things. One of those things is U.S. growth slowing. The other thing, don't forget the jobs report on Friday still matters. That was a bad job report. And then global growth slowing. So again, all of Europe slowing. Brazil votes for socialism. Russia into economic collapse. Japan panics. I'm in the top 7 countries from a GDP perspective in the world, by the way, and they're slowing. So again, when growth slows, what do? You buy long bonds. So again, TLT has been our preferred position throughout the year. EDV is another way to play it. That's 20 to 30 year duration in terms of strips. So again, stay with what's been low volatility and much higher return than the Russell 2000, which basically has no return, by the way, for the year to date. And those are your top 3 things.